Okay, in this video I just want to do a quick review of two really important and tricky questions from Chapter 1. What's meant by the three economic questions and the relationship between scarcity and opportunity cost, and then just have a little bit of an introduction to what is meant by trade-offs. So when we're looking at the economic questions, basically we're answering the question of what consumers produce, how to produce, and for whom to produce. So identify the three essential economic questions that each economy seeks to answer. Using Australia as an example, explain how the economy attempts to answer them. Say this was an 8-mark question, and it probably wouldn't be this tricky within a Year 11 context, but we'll do a tricky one anyway. So the three essential economic questions that all economies seek to answer are what to produce, in what quantities, how to produce, and for whom to produce. In Australia, we have a mixed economy, which means our scarce resources, so land, labour and capital, are allocated 80% based on market forces, so demand and supply, with consumer sovereignty dictating what is produced. So what that means is that when demand for a product increases, producers will shift more resources to produce that product in order to maximise their profits. Rational producers want to act in their own self-interest and therefore produce the products that are in the highest demand because they will generate the highest profits. So make it really clear that mainly what is produced in Australia is through consumer sovereignty, demand and supply, with products that are in higher demand getting a higher profit and therefore more resources being allocated to their production. Governments, though, however, will also step in because the free market is not always good, in that it will overproduce some good undesirable goods like cigarettes, pornography, alcohol, illicit drugs, and they will also promote merit goods or goods that are underprovided like education and healthcare in order to make sure that there's an efficient allocation of resources. So that's the question of what to produce, mainly consumer sovereignty with some government intervention. Then in terms of how to produce, a competitive market like Australia will use the combination of labour and capital that is the cheapest and most cost efficient and will maximise output and profits. Businesses will choose to be either labour intensive, so relying mainly on labour, or capital intensive, depending on what's going to be more profitable for them. So Coles, for example, is now using more self-service checkouts because it's considered to be more cost effective and cheaper than using workers. Governments can also step in. They can provide subsidies or money. Subsidies are just money given to for like research and development into capital, which can make businesses more capital intensive. Minimum wages can make them more capital intensive because they've got to pay more for workers, or they could give subsidies for workers to make you more labour intensive. And finally, for whom to produce. And for whom to produce is a tricky one, but basically it depends on people's contribution to the labour force. So those that contribute a higher skilled labour, have land, are likely to generate higher incomes and therefore consume most of the goods and services. However, the government also steps in to provide certain necessities, like public housing, education and healthcare, and have a progressive tax system, meaning that high income earners pay a higher percentage of their income in tax to reduce the level of inequality. So starting off with very unequal distribution of income, and it's all based on people's ownership of factors of production, mainly skills from labour, with the government intervening to make it less inequitable. How relative scarcity is related to opportunity cost. So relative scarcity means that our resources are limited relative to the demands placed on those resources. We have limited land, labour and capital, but unlimited wants and needs. And because of that, economic agents, so individuals, government, businesses need to make choices about how to use those resources. That's the key thing. Scarcity requires us to make choices. Once we make those choices about how we allocate our resources, we sacrifice the way using those resources in an alternative way. That sacrifice is called the opportunity cost. So whenever we sacrifice to use our resources in a particular way, whatever we choose not to use them in, the next best alternative is the opportunity cost. So, for example, for labour, if you decide to become a doctor, your opportunity cost may have becoming an economist or a teacher or a lawyer, whatever your next best alternative is. Okay, the last part of this chapter is talking about trade-offs and the short and long-term costs and benefits of decisions. So when we're talking about trade-offs and opportunity cost, remembering that relative scarcity requires agents to make choices, every choice has a trade-off. And it's important to recognise that opportunity cost is the most valuable of those trade-offs. So not all those trade-offs, but of whatever we value as the next best alternative. And there can be a whole range of trade-offs at both a micro and macro level. So for example, if we choose to spend more, we sacrifice savings from a micro level. If we decide to work more, we sacrifice leisure time. From a macro point of view, the government wants to boost economic growth. That may come at the expense of the environment if we're cutting down trees and hurting our natural resources. There may be a trade-off for efficiency and equity, which means that we might decide to promote businesses, people working really hard and things like that, but that may come at the expense of unskilled workers losing their jobs or sacking unskilled workers, which could hurt equity. So there can also be a trade-off between efficiency and equity, which we'll look at later in the booklet, later in the year. The main trade-off is referring to current versus future trade-offs. So all economic agents have to make choices which can sometimes balance out sacrificing the future for the current or vice versa. So we need to make trade-offs between current consumption and future consumption. It can mean that our living standards are lower in the short term, but can be benefited in the long term. One common trade-off is whether we choose to save or spend in the short term. Any decision to borrow money today to increase our consumption may reduce future consumption. So here are some examples of the current versus future trade-offs. So for example, in the business sector, when the mining boom was at its peak, so when we were generating high levels of income and high levels of profits from the mining sector, they decided to make a trade-off between their current profits by spending a lot of the money on investment in expanding their capacity. So in order to boost their revenue in the future, they decided to spend a lot of the money or the profits they were earning on expanding the size of their mine. So they made a decision to focus on the future, potentially at the expense of current profits. Another example between current and future consumption would be the choices we need to make related to our aging population. So the government needs to make a choice whether they're going to sacrifice the future or the current, which basically means because we're going to have to spend so much money on funding our aging population, so there'll be higher pensions and less people working, the government may need to do things like increase taxes today to collect more money to give to the older people in the future, which would come at the expense of future growth, current growth and current material living standards. So if the government decide to raise tax to generate enough revenue for the government, that may lead to a slowdown in economic activity, and therefore that may lead to reduced growth in the short term. So if the government implements what we call contractionary policies, which is policies to slow down the economy, they can reduce our budget deficit and give the government more money for the future, and therefore hopefully keep taxes down in the future, but they may hurt the current generation. Okay, we'll talk about short run versus long run trade-offs in the next video.